Yeah, welcome everybody. This video one is just going to be about how to mark key levels and why we should do them. Okay, right, you got to understand key levels. It might be challenging for you at first, but really they're easy to identify. Okay, what key levels are? They're basically value areas that provide you with a good trading edge, a good place to execute trades, good place to set stops, and a good place to set your targets. They're really powerful levels. Institutional traders are engaging the market there, and they're really true areas of support and resistance. So, they're really powerful tools. They can be the beginning of a trend and the end of a trend. So you can actually set your execution where you enter the trade, and you can actually set your target there. Typical behavior at these key levels is that price will be sort of like gravitated towards them like a magnet. You'll find that at a key level price will range. So yeah, they're really before it breaks out. So it's basically they're areas where price can accumulate or bounce right off for a spectacular trade. You'll get to understand key levels as you get to use them more. You'll observe the behavior around them. Okay, but trust me, they're easy to identify. And what we're going to do now is identify the key levels on this chart in front of us. So if you're looking at the New Zealand dollar, that's in front of you, and you might be able to see now that you've got price, which is at my mouse, which is 064537. That's a key level that we marked earlier. Okay, so you can see that price is gravitating around and ranging around this key level as market decides whether to break up or break down. Okay, key levels are easy to mark out. So what we're going to do, we're going to take this chart and I'm going to show you how to mark key levels. First thing, we go to a monthly chart. From the monthly chart, just expand it so you can use it. You can see this key level is marked out. Why is this key level marked out? Because it shows the open of this candle in June, and it shows the close of this candle. As you can see, they both closed at the same level. So that's a significant level, okay? Because that shows that at this price, sellers were not willing to sell below this price on this candle open, and buyers engaged the market at the close of the previous month, which means that this month we're trending higher than the prior month. So if you go across the chart and go further left, you can see that this level was first created in December prior to the current month, which is June. And if you go across more, you can see this level was also touched in September. Okay, and you can see there's a significant reaction at price each time this level is touched. Okay, how do we mark them out? Well, there's the open, there's a close. Let's mark a few out. It's quite simple to mark out. Let's go to this one here. Let me just mark that and reduce the size of this. It's a little bit big for us. The width of this line is too much. There you go. Alright, so you've got two key levels marked now. So this is marked from August, okay? So we know that that's a significant level, right? Because this level on August has been touched various times. In August, touched again, same level, see? Touched again in December, and touched again in this candle on October, which shows you that the market respects this level. Significant reaction at this level in December, market shot right up. Significant reaction on this level in August, market shot right up. Significant close in July, market closed here, rejected bears here, and the bulls pushed the market right up. Okay, so we know that's an important level. Let's mark some more out. They're easy to mark, and how you will use them I'll show you later. Now let's mark this level right here. Okay, price was rejected in November. Why? Because price was rejected here prior in June. Price was also held above this level, so it's a true support in December. So you look back and you see the importance of this level. And if you look at this month here, you can see a rejection as this is acted as a resistance, and here it acted as a support. There it acted as a resistance, all across the same level. Okay, so what we want to do, we don't want to mark every single monthly candle open and close, because essentially that's what we're doing, marking the open and close of monthly candles. But we only want to really mark the ones that are significant to the current price of the market now. Otherwise you'd be marking every single candle. It's not really required. Okay, you're marking these because you want to set this as places you want to execute trades, and then you want to have a target. So for instance, here's the actual current market price. So you'd look left and you would say to yourself, well, why did we close at this price on this candle? And if we mark it, you can see the reason for that is there was significant rejection. Well, we're not really rejected yet because the month is still open. This month isn't closed. So if we mark that one where we are current price, you can see this this tail here, what we call the shadow of the candle is rejected here. So if you were around this price on Friday, you'd be saying, okay, maybe I target this and get out before the weekend, or maybe I target this area. And if you see this area, there's always significant reaction as well where price closed. Here we touched and we shot right up. There we formed the doji, yeah, and then shot right up. Here we formed a beautiful engulfing candle, bullish engulfing candle at the same level back in February, and shot right up. So you can see these levels are really significant. So imagine that you were in at this level that we marked off, this one here, 63,376, then your target would be the next level. Okay, and then if we are accepted to trade above this level, your next target would be this, and your target 3 would be this. And if you break this level, then you would say, hang on a minute, I need to get more levels to target, to set targets and execution points. So you'd mark the next level up if we were in a bullish market. So let's turn this into an hour chart and see how price reacts at these levels on a smaller time frame, because it's a big, if you trade on the monthly chart, you won't really see the price action on a daily basis around these levels, because on a monthly chart, obviously, it's such a big time frame to see the price action. So first, let's have a look at the hour chart. Shrink it down, and now you're seeing these levels play out. Let's see what we've got below first. Do we have any below? Not really. I'm going to switch over to a 4-hour chart so we can get a better view of these levels. Okay, so what do we have? So you can see when price is around this key level, you can see the reaction of price, bounced, test the next key level up. Okay, price then is accepted, so it tests the next key level, price accepted, test the next key level up, and you'll see this play out throughout the market. Here price is rejected at the key level, test the next key level, is accepted, is rejected again, so price tests the next key level. Okay, price is rejected before it reaches this key level and retests the key level up. You can see the bounce off, touch the next key level down, and then is rejected here, accepted here actually, and then it moves up again. So you can see how these key levels are playing out. So as a trader, you can see that these levels are really important for you. So let's go down to a smaller time frame and look at these key levels, how the price action is around these key levels. And we can use these to set targets, to set execution points. Just let the chart load, guys. Hopefully it will. There you go. So if you look at the 15-minute chart, you can just see this key level was rejected and went down to test the next key level, which was then rejected. Okay, and you can see price was not accepted. Price was accepted at this level and moved up. Price was rejected above and was accepted below, and price moves down. You can see price here just playing from one key level to the next key level and to the next key level. Okay, so if you look at this, these are significant levels where you would probably very likely want to be executing trades. And when you execute trades at these key levels, you want to basically set a target to the next key level. Okay, so that's how they play out. So they're very important levels, and that could be your origin of a trend. Here we have a significant downtrend, and we can say we're trading now from this key level. So we're bearish on this pair, and we're bearish because the volume is pushing price down from the key level to test the next key level. So price pushed down, retested that key level up, pushed down to the next key level, went up, went back, went down all the way here, and then you can see price retest this level, rejected, pushed down, tested this key level, tried to push down. Yeah, bulls wouldn't accept the price to go lower, so they broke it up on above this key level. So they retested the next key level up. Okay, price is rejected, and they pushed price back down to the key level where it came from. There was some consolidation across here, and then price again was pushed down from this key level, retested the key level, tried to get it. There was some absorption here at this key level, didn't quite reach it, and price was pushed down and retested, pushed away, retested. Okay, and eventually price is accepted above this level, so it probably gapped back down, retested and bounced up. Yeah, there it's gapping back down to the key level, so you know this is significant. Yeah, this is like the line in the sand where bulls and bears are trying to defend their positions. Yeah, on this key level. There you go again, retested the level up, went back, retested the next level. Okay, pushed back up again, retested, and finally broke out and retested the next key level up. So you can see how this is playing out now, and you can see that key levels are significant areas of support and resistance. You get this sort of price action at key levels because institutional traders are engaging the market at these levels. All right, so now we've reached up to this key level up. Price is consolidating at this key level. You can call this accumulation. Volume is built up here at this key level. Then you can see price move up and test 67,167 to the next key level up here. Price rejected down here. Retested this level, pushed right back down, back to the key level here, which was tested earlier, and price retested that level. Now it's retested this level, and so on, and it ended up with a great big pin bar. Okay, So that precludes key levels. So from that you can see the significance of them, because the market will move from that area and the market will test the next key level. Um, right. The next video will be after this. We'll follow through. We'll do this in short video segments, and the next one will be to how to add your trend lines to your key level chart. Thank you very much. Hope you enjoyed this video, and I look forward to seeing you on the next video. Thank you. All right.